Well, hello. We are here on video 2 for chapter 8, and we are talking about the acquisition and expenditure cycle, and as auditors we are auditing primarily accounts payable and expenses. Alright, so we are keeping in mind inherent risk. What could go wrong? Alright, so depending on the account, different things can go wrong. We just can, as auditors, what we have that's nice is we can go through the assertions and say, well, what could happen, right? So for accounts payable, with respect to completeness, not all liabilities could get in there. Leave off some of the payables. Cutoff gets in the wrong period. Existence, not actually obligations of the company. So if you have an employee committing fraud, right, and they are purchasing inventory, let's say you are a purchaser in the purchasing department at Best Buy, and you have the ability to purchase, I don't know, TVs and laptops, right? Those are something that you could sell pretty easily on eBay, make some money, right? So if you could order those things, have them sent to you and turn around and sell them, that would be great for you, right? It'd be wrong, but you could make some money. So when an employee is committing fraud, the obligations aren't really the company's obligations, right? But they could get in their books. So again, that's a thing that could happen. Presentation, not recorded in the proper accounts, not footnotes, not disclosing properly, valuation, the incorrect amount. And expenses, again, same thing. You go through the applicable assertions, and of course the main assertion people want is they want those expenses to look lower than they really are. So the completeness assertion is important for expenses just like they are with payables, or people want to understate expenses. They tend to not want to overstate expenses. So looking at cutoff, that's a way people understate, is they shove it out into another period, right? So it's in the wrong period. That's what cutoff means. Accuracy, an incorrect amount, and classification, not in the right account. In other words, the typical way that this happens is they capitalize their expenses. They call an expense an asset when really it's an expense. Alright. So we need to understand the controls, right? So we're going to understand them and we're going to test them. So what controls should your client have in place, right? So as the auditor, now you understand the cycle, what they're doing. You understand the inherent risks, right? Understatement of payables and understatement of expenses. So what processing controls should your client have in place? So this is what you're looking for and trying to understand so you can decide how to test those controls. Alright, so what should be happening at your clients? Well, information processing. So what I mean by is when they pay or make a purchase, what kind of rules are there in place for making those payments, for making those purchases, right? So before a payment gets made, compare the purchase order with the bill of lading. Right, so you're making sure that you got what you actually ordered, or that you received something you actually ordered. Compare the quantities, right? Did we really get everything we ordered? Is some of it sneaking out the warehouse? Compare the prices, that's going to accuracy. So somebody at that client should be taking those purchase orders, taking those bills of lading, taking those invoices, double checking. Did this vendor charge us the right price, right? Recompute that in. Are the extensions correct, right? You don't just write a check and pay it, right? You have to get everything together, right? Determine when to pay it, right? Prepare a voucher. That's that document we talked about that goes to Treasury to get the check cut. A voucher packet would have the purchase order, the receiving report, and the invoice. And somebody would be inspecting them all to make sure those prices are right, that we really did order that. You certainly don't want to be the company who accepts anything that comes to their warehouse, right? You'll start getting a lot of bills for stuff you didn't order. Are the prices right? Right? That's a vendor might want to make a little extra revenue by charging you a slightly higher price. And as the accountant who doesn't do the ordering, you don't know what the price is. If somebody hasn't checked that invoice against the price list, you don't know, right? So you have to check all this stuff. And so then you prepare the voucher and it goes off to get paid by usually the Treasury Department is who has checks and who cuts checks. Of course, again, all of this is on a computer. I mean, it's easy to imagine somebody taking three pieces of paper, right? Here's my invoice, here's my receiving report, here's my purchase order. I look at them, I compare them, I write out a voucher, and I give it to the people who cut the checks. Typically, it's all really in a computer, but that's kind of the idea. All right, so let's talk about segregation of duties in this cycle. Well, we've already talked about how important it is to have the custody, the authorization, and the recording, CAR, C-A-R, custody, authorizing, and recording. Recording means the accounting, right? So separation of duties, you can't have, especially in purchases, right? Because you're purchasing stuff that people might want to get, right? And you're issuing checks. People might want to have checks issued to themselves, right? So you have to keep this segregation of duty to make sure that the invoices the invoices represent actual purchases for the actual company and not some occupational fraud by an employee, and that nobody's getting checks cut for themselves, that there aren't fake vendors being used to make fake purchases. So we need to have all these segregation of duties going on. So the authorizing is done by a separate purchasing department. Managers don't just decide who they want to buy stuff from. Typically there's a control that says we're going to get only authorized vendors. This prevents a lot of employee fraud. There's a lot of invoice related employee fraud. They get fake invoices from fake vendors and get themselves checks cut. So you make sure that it's an actual purchasing department who's making sure these vendors are real vendors. There's a warehouse somewhere who keeps custody of the inventory or the things that come in. So a person couldn't order something, get custody of it, and do the accounting so that it kind of disappears off the books, right? So you've got this authorizing and the custody, and the accounting department is using, of course, subledger, right? So you keep track of each separate account payable, and you're not posting to the general ledger account payable control account, right? So that the control account is the total balance, right? So if you were to look at a balance sheet for the accounts payable balance, you'd be looking at the control account balance, all the accounts payable added together. But you don't actually post to that account. You post to each separate one. We owe this vendor $100. We owe that vendor $200. And so you're posting to each separate sub-account. This prevents, again, people messing with the books, and make sure you have real vendors on the books. Of course, somebody at your client should be reconciling liabilities to the statements and the ledger account. So we should be getting statements that say how much we owe, right? It should match with what the subledger says. Somebody should be verifying all this at your client. And bids are received by somebody independent of the purchase decision. And occupational fraud typically can involve kickbacks to purchasing agents at companies. So you have to make sure that bids are fair and they're not rigged. So there should be some controls in place at your clients to make sure that they're actual purchases that are in the best interest of your client. there should be some actual physical controls in place, right? You have to have actual receiving report prepared when the inventory comes. So when the truck backs up to the warehouse, somebody's there to log in everything that comes. And they should be logging it in as it comes off. They shouldn't have like the purchase order in front of them and go, oh yeah, we got 53 boxes. They should be actually counting them and writing how many they got, right? So you're verifying that. And of course, obviously, not just anybody should be able to have access to the items that are purchased, right? That's kind of makes sense. Warehouses have locks on the doors, right? For good reason. We should be comparing data from previous years, right? If we always purchase certain things, not we auditors, our clients. This is all controls that your clients should have, right? We're going to check to see if our clients have this stuff going on, right? So they should be checking to make sure that prices are going in the right direction, that we haven't all of a sudden started buying a lot more of something if we haven't started selling a lot more of that thing, right? So our clients should have methods in place that ensure they're keeping track of what's being purchased, right? And they're checking up on that. And they should also make sure that they're purchasing from legitimate vendors, be reviewing the bids, make sure that the purchases are coming from real vendors and not fake ones, and make sure that there's no kickbacks or anything going on with vendors who are dishonest. All right, so that's understanding the controls. All right, so when we come back, right, we're going to talk about testing these controls, right? So we've gotten so far, we've talked about inherent risk, we've talked about what controls should be in place to control the inherent risk, and now we're going to talk about testing those controls, because that's what we as auditors do. We understand, then we test.